Chipotle recently announced one of the biggest stock splits I've ever seen, a 50-for-1 stock split that will have a massive impact on the price at which Chipotle's shares trade. Now, this is a company that has never split its stock, so shares are trading at nearly $3,000 per share as I'm recording. The ironic thing about stock splits is it doesn't fundamentally change anything about a company. The company continues operating, you continue owning the exact same percentage of the company after the stock split happens, but there's a psychological impact. And that's the reason that companies split their shares of stock. It's the reason that most stocks trade between about $10 and $100 per share. Those are easy numbers to get your head around. It's easier to create options contracts, both in public markets and for employees, and you're not dealing with so many fractional shares. So I want to go through the details of this announcement today, what impact this is going to have on Chipotle's shares, if there's any impact at all, and what investors should expect going forward. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's go right to the announcement to see exactly what Chipotle has to say. Now, this came out on March 19th. Chipotle announced that its board of directors has approved a 50-for-1 split of its common stock. They even say that this would be one of the biggest stock splits in NYSE history. This is not something that companies can just do on a whim by themselves. The number of shares of stock and the par value or original value that you put on that stock is actually part of the company's fundamental structure, and it's actually reported each quarter. If you go to the income statement, you can see how many shares are outstanding and what the par value is. So if a stock has a par value of $1 and there's a 10-for-1 split, the par value goes down to 10 cents and the number of shares outstanding goes up by 10x. So that's the way that you can sort of see these things happen. Typically, public companies that have been around for decades might have really low par values as a result, but it also could be the impact of the rise in valuation while a company was private. So you might start a company and say, hey, we're going to give ourselves $1 million valuation at our first funding round. We're going to say that each share of stock is worth $1 and there are 1 million shares of stock. And then as you split those shares, you have to adjust that par value as a result. So that's sort of the history and mechanics behind it. But what they say is they are going to go to shareholders with this on June 6th, 2024. And if the certificate of incorporation amendment is approved, shareholders of record on June 18th, 2024 will receive 49 additional shares of stock, and they will be distributed on June 25th. This is again something to understand about the mechanics of both dividends and stock splits. The shareholder of record is going to be the date at which a stock closes that you own a share of stock. So if you own one share of Chipotle stock at the close of trading on June 18th, 2024, you will see those extra shares of stock, but they won't actually show up in your account until Wednesday, June 26th, 2024. So about a week later. Now, these are typically things that happen in the background. You don't actually notice it as an investor because the brokerage handles it for you. And if you sell your share of stock between June 18th and June 26th, then you're not going to just get 49 shares of stock because that split is going to follow the share that you owned. But it's just worth keeping in mind that this is a split that we won't actually see happen until June 26th if it's approved as currently contemplated. And typically what will happen is that the stock will start trading at 1/50th of the price of what it was trading the day before the split takes place. So the split takes effect before the market opens on Wednesday, June 26th. Theoretically, shares would go from about $3,000 per share on Tuesday to about $60 per share on Wednesday. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So the split is often something that investors really like, that this is the kind of thing that can give a pop to shares on a short-term basis. But the really strange thing is that even though stocks typically react positively, it's not because you're fundamentally owning anything different in a business. Like I said earlier, you own the same exact percentage of the business, whether you own one share of stock pre-split or 50 shares of stock post-split. Any sort of dividends are going to be adjusted as well. So you're not going to get 50 times the dividend. So there's really no reason for this to take place, except for the fact that the number on the screen when you're trading a stock goes from $3,000 to about $60. And that's really the reason that these stock splits happen. This is the reason that most stocks trade in, like I said, that range of between $10 and $100 per share. And there are decent reasons for that from an employee perspective. If you're granting stock or stock options, you may want to grant people 100 shares or 1,000 shares of stock or stock options. If your stock is $3,000 per share, it's a little bit harder to say, okay, we're going to grant you 0.1 share of stock or one option. It just doesn't sound as good. So again, it's just psychological. There's nothing fundamentally economical behind it. You can do all of these things, but people just feel better about getting 100 shares of stock than they feel about getting one share of stock. And that's really the reason behind it. There are some trading mechanisms behind it, and that gets to the way that the stock market works. Typically, stocks are traded in what's called round lots, or lots of 100 shares of stock per trade. That's what institutions and brokerages are going to be typically trading. Even if you or I are going to be trading 1, 2, 3, 4 shares of stocks, even fractional shares of stock. But typically, if you look at each individual trade as it happens on the market, it's going to be 100 shares here, 100 shares there. And if you have a stock that's trading at $3,000 per share, that suddenly becomes $300,000 per trade. If you're making a market for that, that's a huge risk to trade that amount of money with a single transaction. So if the stock goes down to $60 per share, now suddenly that round lot, that 100 shares that are going to be traded, is going to be trading for about $6,000. So much easier from a market making perspective to be selling that stock at that much lower price and make a market that's potentially narrower for investors, meaning the difference between what market makers will ask to sell the stock and what they want to pay to buy the stock, that it's going to narrow down if the stock price is lower. That's the theory behind it, at least. Now, a lot of these things made a lot more sense in the 1980s, 1990s when I started investing, because we didn't have fractional shares. Transactions were $20, $30, $40 per transaction. And so it made much more sense to do round lots and to spend $6,000 in this case per transaction, rather than going in and just saying, hey, I want to buy $50 worth of Chipotle stock. It doesn't matter to me how many shares there are. So that's the advantage of the electronic trading that we have today, but there are still some of these legacy impacts and psychological impacts that we have from stock prices and what we think about a stock when we simply look at the price of shares. So that's some of what is going on with this stock split in particular, and why we're seeing more and more stock splits as the stock market continues to rise. I think this is probably something that we're going to see. It was kind of in vogue a few years ago to keep your stock price really high. We saw Amazon do that. Berkshire Hathaway did that for decades. They eventually split their shares and then split those B shares again to keep in that more normal trading range. So I think we're starting to see the market move back to that $10 to $100 per share as a more normal trading range that a lot of companies want to have their stock trading in. And these are some of the reasons behind it, despite the fact that it doesn't fundamentally change the economics of the business or what you own in the business. So what do you think about Chipotle's stock split? Leave your comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.